1.2 million euros gone to taxes. Same income, same business, but two completely different outcomes. Last month, I was reviewing portfolios with two clients. Both made around 3 million euros a year. One lives in Switzerland and paid off 1.2 million euros in taxes. And the other one moved to Dubai 2 years ago, but his tax bill, zero. Not 10%, not 5%, zero. And before you ask, both are 100% legal, fully compliant and doing business in Europe. So in today's video, we're setting this once and for all. Dubai versus Switzerland. Which one actually protects your wealth better in 2025? Let's dive into it. I'll show you the exact numbers. I'll break down the hidden cost, and by the end of this video, you will exactly know where you stand and what to do next if you're tired of paying more than what you need to do. Dubai is now home to 81,200 millionaires and recorded at 102% growth in millionaires between 2014 and 2024. So that is literally the fastest growth of any major financial center. So now the question is, what drives this exodus? And a recent house and house analysis shows a 93% increase year on year in Dubai property transactions above 10 million dirhams between January and May 2025. And we're not talking about small money here, guys. Meanwhile, Switzerland is experiencing the opposite trend. The latest research from the Tax Foundation reveals something shocking. Many developed countries have repealed their wealth taxes because they raise little revenue, create high administrative costs, and induce an outflow of wealthy individuals. So that is a real problem right now. And the UK is forecasting to lose 16,500 millionaires this year in 2025. That is the biggest net outflow globally. And where are they going? Dubai tops the list. Assets under management in Dubai's wealth management market are projected to cross $195 billion this year in 2025. So that's not speculation, that is institutional money moving now. Dubai ranks at 16th globally in the latest Global Financial Centers Index, while the Dubai International Financial Center, or the IFC, currently has over 420 wealth and asset management firms operating. So think about this. Boston Consulting Group reveals that the UAE's bankable wealth hit 1 trillion in 2024 and is now in its pace to grow to 1.5 trillion by 2028. So what is driving this growth? And I can tell you, it's not the zero personal income tax. It's the entire ecosystem here in Dubai. And billionaire Ray Dalio, we know them all, founder of hedge fund Bridgewater Associates and other hedge funds, including Breven Howard now, have a presence in Abu Dhabi. So these aren't tourists, guys. These are the smartest money managers in the world setting up permanent operations here in the UAE. And the UAE Golden Visa program grants foreign talent the right to live, work, and study in the UAE, while exclusive benefits that traditional visa systems cannot match. For millionaires, this represents permanent wealth preservation. The regulatory environment is extremely favorable. According to Brandon Robinson, deputy head of private markets at JP Morgan Asset Management, when JP Morgan says the regulatory environment is favorable, we listen. Now let's talk about Switzerland, and I need to be really honest with you about what is really actually happening there. Switzerland levies wealth tax at the cantonal and municipal level with no federal wealth tax, meaning you're entirely dependent on your canton for how much wealth you'll pay. The latest research from CEPR reveals something most advisors won't mention. Swiss wealth taxes account for 3.6% of tax revenue, and that is by far the highest level in the OECD. So you're not just paying income tax, you're paying on your assets whether they make money or not. By referendum approved in November 2024, Switzerland implemented a reduction in taxation of between 11.4% and 5.3% from January 2025. Sounds good, right? But here's what they don't tell you. Swiss wealth taxes range from 0.13% to 0.94%, depending on canton and municipality. And wealth tax is levied against worldwide assets of Swiss residents. So let me break this down very quickly for you. You have 10 million euros in investments. Even at the lowest rate of 0.13%, you will pay 13,000 euros annually just for owning assets. And at the highest rate, 94,000 euros per year. So whether your investment makes money or loses money. As of 2025, information about any Swiss bank account you own must be reported to the tax authorities, and the wealth held must be accounted for. The legendary Swiss bank secrecy is largely gone for tax purposes. So let me show you what this means with actual numbers from our latest client cases. Let's say you're making 5 million euros annually from your business in Switzerland. You are going to be paying immediately 2.3 million euros to the government. So that is nearly half your income literally gone. But wait, it's going to be worse. And that is that if you've built up to 20 million euros in net worth over the years, Switzerland wants another 188,000 euros just for owning those assets. What is going to happen with your annual tax bill? 2.5 million euros. And in Dubai, you are going to keep every single euro here. All 5 million euros stay in your account. So that is 2.5 million euros extra every year to reinvest, grow your business, or secure your family's future. But what about your investment portfolio? This is where Switzerland really shows its true colors, because your stock portfolio goes up to, let's say, 20% in 1 year, you are going to pay wealth tax on the new value, and it crashes 30% next year, you will still pay wealth tax on what's left. Win or lose, Switzerland is going to get their cut. And Dubai takes a different approach now. Your portfolio doubles, keep it all. You pass it to your children, no inheritance tax. You sell everything and move the money offshore, no capital gain tax. This isn't theoretical. UBS Global Wealth Report 2025 highlights Dubai and the wider UAE as top performing regions in Millionaires expansion, calling Dubai one of the world's most dynamic and resilient luxury markets, as they say. In 2025, global millionaire migration is set to rise to projected 142,000 relocations, up from around 134,000 last year in 2024. But where are they all going? Dubai expects to gain 7,100 new millionaires this year in 2025. As in James Place, the UK largest wealth manager, recently launched at the first Middle East office in Dubai International Financial Center, with their executive describing Dubai as offering the vibrancy of London City with year-round sunshine and zero income tax environment. So when the largest wealth management firms are moving operations to Dubai, I think that is telling you enough about where sophisticated money is flowing these days. So looking at all the data, Dubai wins on zero personal taxation, verified by multiple government sources, rapidly growing wealth management infrastructure with $1.5 trillion projected by 2028, golden visa programs providing permanent residency options, and also regulatory environment that major financial institutions calls extremely favorable. So Switzerland remains relevant for traditional European market access, established private banking relationship, and specific family office structures requiring European presence. But the numbers obviously don't buy. With 13,000 new millionaires relocating to Dubai in 2024 and luxury property transactions nearly doubling in 2025 this year, the smart money has already made its choice. So this wealth migration data shows that this isn't a temporary trend. Dubai's Golden Visa program eliminates literally the uncertainty that plagues wealthy individuals in other jurisdictions. And Switzerland still charges wealth tax on assets whether they appreciate or not. Dubai literally charges nothing. Quick choice if you have to choose in between them, I guess. So the choice obviously seems obvious, but your situation might be different, of course. Maybe you need European market access. Maybe your business requires Swiss regulatory framework. works. Maybe your family situation demands European residency. All very important to think about. That is why we don't give cookie cutter advice at Emifast. We really analyze your specific situation based on the latest data and regulation. So please don't wait for tax laws to change against you. The research shows that Dubai's advantages are structural, not temporary, and Switzerland's wealth tax aren't disappearing, they are embedded in their entire system. So now the question is, what is your next step? Visit us at emifast.com or book a free consultation here under in the description, and we will analyze your specific situation using the latest 2025 data and show you exactly what each jurisdiction means for your wealth, all for free. What questions did you have about Dubai versus Switzerland? Drop them here under the comments and I'm gonna read every single one of them, and maybe one of the questions become one of our future videos. Don't forget to like this video if the research helped clarify your thinking, subscribe for more data-driven insights on international tax planning, and hit that notification bell so you will never miss our latest analysis. Guys, thank you again for watching, and in a world where governments compete for your wealth, choose please the right jurisdiction that rewards success rather than taxes it away. See you in the next one.